as well. You've got very, very subdued kind of rates coming through. So a quiet start. Will it be quieter markets is the question as we go forward. We'll see. But for now, it's not very much at all coming through. The Nifty heat map will give you a quick sense of what's up and down in the Nifty. I mean, the majority is down in the red, and you got a few winners up in the green as well. HUL trend reliance. For the Nifty, it's about 20-point cut right to the word go. Surabhi.
Actually, some of these Q1 update results are very, very interesting. Godrej is getting the full marks. It's the best performer in terms of all the weekend Q1 updates that came in. Almost 5.5% higher. Keystone's numbers were very good as well. Keystone's up 4%. But look at Jubilant. Jubilant, the numbers looked okay. Q1 update, 11%. Domino's growth, but stocks down about 2%. Anyway, more on the updates in just a bit. Let's talk about what's moving the large cap screen. We're 40 points down on the Nifty. BEL, Tech Mahindra, IndusInd Bank lower by about 1%. IndusInd Bank also lots of issues on the business side. I mean, the stock's fairly resilient, actually. I mean, if you judge by the metric of just what they've done in the first quarter. But anyway, that's IndusInd. HCL Tech, Shriram Finance, Bajaj Finance. Financials are again weak. I mean, banks and non-banks. ICICI Bank, lots of weakness over here. Early weakness that we can spot. Tech Mahindra, Wipro, Infosys. So even IT is not really firing up for the bulls today. At least not at this point in time, early in the morning. So let's see what's holding up the green side. It's actually all consumer. That great consumer trade has begun, and this is what we discussed a lot, even in the editors' roundtable yesterday. Nimesh had put out a piece. Now, the question is whether this trade will really, reach its logical conclusion. HUL, Asian Paints, Trent, Nestle, Tata Consumer. I'm reading on the top 5 names on the Nifty, and they are all consumer. So that's where the market focuses. That's where the expectations are running high. And we'll have to see if the companies can deliver.
Well, that's right. And let's focus on a few names then. The OPEC plus cut was actually OPEC plus hike of crude production was 30% higher than what was expected at around 570,000 tons barrels per day. In fact, the expectation was around 410,000. So you have HPCL actually that's open gap up. So keep an eye out on that one. Besides that, Godrej Consumer, Nuvama said that they were quite positive on the revival, and the evidence was in the numbers as well. They're expecting things to bottom out. That stock's clearly flying away. Dabur, with the numbers look so good, well, that stock as well is higher. Dream Folks, we did see some fund-based selling, and that stock, in fact, has now gone to around 180 rupees, falling on massive volume, 6.5% lower. In the last 45 days or so, the stock has lost close to around 30% of its market cap. So big downtick is what we're seeing on that one. Kalyan Jewellers, well, the numbers look pretty okay, but the stock has come in for some profit taking. So that's down close to around 2%. DCX Systems from the defense names, well, that's moving higher in relatively large volumes, close to around 3% higher. Volumes much higher than what we normally see. So big up move is what we're seeing on that particular name. The other one that's moving well, Sirca Paints. We don't normally talk about this name, but that stock, in fact, is higher. And Axis Gates as well is up close to around 5%, and that's been moving on a periodic basis on circuits. Keystone Realtors, Rustam Ji, the reason that the stock is higher is because the pre-sales have grown by 75%. Remember, they've already clocked 1,000 crores. Last entire year was around 3,000 crores, so the street likes that. Also, business development in the first quarter, they've added 3 new projects, GDV of around 7,700 crores. That's surpassing the entire guidance for the year as well. So on the back of that, that's holding with a gain of around 3.5%. Thumbs up on that name.
Okay.
By the way, Nigel, did you mention Borosil Renewables?
No.
Very interesting, and that's what we were pointing out. There is the German subsidiary that's filed for bankruptcy, but why is the stock still up? Because it's a sense of relief and maybe a sense of completion, and let's move on beyond this, because it was a loss-making entity. I think Borosil's exposure was over 300 crores to this, and maybe the market is seeing as some finality and then moving on to the repair work. Prashant.
Absolutely, and more on Borosil, and we'll of course try and get in touch with the management as well as we go along. What do we have on the downside? It's interesting. BEL is the top volume-led loser. It's down 2%. And Paras Defense is down about 5% as well. Now, it's not, defense in every country is very different. But last week, the best performing defense pack in the world has been Korean defense companies. They were all down. There was that entire pack, the index was itself down some 8%, Friday to last Friday. So, we'll see. Here, of course, news flow has been positive, but stocks, of course, have run up in some cases far ahead of the news flow. In any case, I mean, there's this order-related tailwind here. We'll see. Angel is down 2%. There was a call from Mitesh which came in earlier. Kalyan Jewelers is down 1.5%. Jubilant Food is down about 1.7%. Indus Tower is down about 2.5%. Garden Reach is down about 1.5%. Dream Folks, Nigel mentioned 180, down about 5.5%. Credit Access is down about 1.33% or so. Deepak Fertilizer is down about 2%. But then after that, volumes really fall off a cliff. So just there's serious volumes, at least out of the gates, in about 10, 12 names. That's it on the downside, but more on the upside, but not really that much. IIFL is coming up. It's almost nearing that 500 rupee mark after a while. So IIFL has seen a fair bit of repair and recovery over the last few months now, actually, last 4 or 5 months now. Relaxo is coming up. I mean, that's the chappal maker, 6% higher, 492 on Relaxo. It's the fourth largest volume-led gainer on the NSE. So it's price gains plus volumes. Shipping Corporation of India is up 3.3%, and Godrej Consumer is up 5%. That's the largest volume-led gainer, which is coming up right now. So more on this as we go along. But for now, it's Nifty back in the green, but just about 10 points or so. Still pretty quiet, 24,472. Manish Sontalia is with us now, Chief Investment Officer at MK Investment Managers. Manish, good to have you with us here. Thank you very much for your time. Let's just sort of dive straight into the capital market plays, which has been such a darling for the street for obvious reasons. Do you think that trajectory, especially not for all, but for some, not obviously for the wealth guys, etc., but for some gets dented because of the regulatory actions we've seen? It of course started with on the F&O side, but now we're seeing it on the Jain side, etc., as well, and I think needed. But there are secondary implications as well. What's your sense?
So, Prashant, I think it's just a blip. Capital market plays a strong place going into the medium and long term. Of course, there's a knee-jerk reaction on the downside. Exchange volumes are going to fall 4-5%, to say the least. But I think newer players are also going to enter the F&O space now that this one entity would be out, and there'll be normalcy in terms of the trade patterns, etc., on the exchanges. And given the fact that March onwards, you have seen a very strong capital market rebound, which is going to have a rub-off impact on your earnings for the first quarter as well. All capital market entities are going to report better than estimated numbers. That was the case in the fourth quarter when the markets were really down. So all in all, I think the capital market plays are a very good buy on dip. And obviously the RTAs, the online brokers, the depositories, they would all be fantastic plays, the wealth management guys. Yeah.
Okay. Manish, hi. Thank you so much for joining in. I want to straight away get to you on this whole consumer debate, right? Because we were just saying this, and this has been building for a while. The market's big hope on the return of the great FMCG juggernaut. I mean, if not FMCG in some format, I'm saying, bottom or middle of the pyramid consumption, because till now consumption is only top of the pyramid. Expensive watches, jewelry, top dollar apartments, etc. Do you actually see the bottom of the pyramid consumption coming back? And if you do, then what sort of stocks would you be looking at?
So, I've been maintaining for a while that consumption is going to make a comeback. The pendulum is going to shift away from investment-related themes to consumption-related themes, thanks to the government's impetus on providing income in the hands of the middle class. That was not the case over the last 2 years, where they have been beaten down heavily by inflation as well as very high taxes. Come this financial year, obviously you have 1 lakh crore savings in income tax, which will create a multiplier on the consumption side, more on the discretionary consumption side, and also on the rural consumption side, that we are seeing that, rural economy has turned a corner and monsoons are pretty decent. So even that is going to have a positive rub-off impact. And obviously the consumer names, you can deal with anything. Of course, one needs to figure out where the consumer would primarily have preference first. So it could be your, travel, it could be your hotels, QSRs, You could be dealing with automobiles, personal vehicles, health insurance. These are some of the consumer discretionary names which are definitely going to benefit. Of course, you have another added impetus coming from 1st April 26, which is the 8-pay commission. So all in all, the consumption names have not done well over the last 2 years. Now it's the time to actually, for them to actually have an outperformance going forward.
Hi Manish, good morning. Good to see you, Ben. You don't shy away from stocks as well at times, and on a periodic basis, every conversation you've given us one. Star Health, I recall, it was the one that people were not looking at. You said, post the correction, valuations and the business itself seems to be looking up. And that's been actually a contra call that's worked very, very well, if someone heard you. But the question is, today, what are you going to be telling us? Which is that stock that you're actually looking at, which, could have underperformed, has valuations in favor, and prospects look up from here on? Please go ahead, Manish.
So, Nigel, ever since RBI has given a front-loaded rate cut and pretty heavy dose of liquidity, I think some of the, the capital market players, and we alluded to the names, the all well-known names, these would do well. You will have the real estate. So the whole thesis is that markets are going to overshoot fundamentals. And obviously, we are closer to now all-time highs, and they'll be overdoing things. So asset price inflation is basically the major theme going forward. Plus combine that with consumption, which is basically having a fundamental thing. So all the real estate names, the NBFCs, you have many of the NBFCs, the housing finance companies, not the PSU ones, but the private sector ones, which are projecting 20% sort of a growth available at, let's say, 1.5 times PEG, so on and so forth. Or you'll have, let's say, the public sector banks per se, which are available at very decent valuations. You'll have the infrastructure names, which gets boosted due to lower cost of capital as well as benign commodity costs. So these are some of the areas where I think, the new underlying bullishness would come through just because of the RBI's action very recently.
In each of these themes, you want to give us one particular name?
That's difficult, Nigel. The regulatory constraints.
Manish, just to go back to that point on consumer, since you're convinced that there is indeed going to be a pickup again, but what would be the best ways of playing it? Would it be plain vanilla FMCG? Should it be, two-wheeler companies? What else are you looking at? Could it be QSRs, for instance?
Hotels, consumer tech, look at QSRs, you look at fast fashion, retailing, whether food retailing, whether apparel retailing. These are some of the names where you have fantastic names available. Jewelry retailing, to say the least. Ethnic wear retailing. These are some of the names which will benefit. And as far as FMCG side is concerned, let me give you some insights. One insight, basically, which I have gathered over the recent interaction, is that, D2C is hitting the incumbent FMCG companies in the urban markets. And, there is heightened competition in the urban, because FMCG broadly are areas where things are very, very penetrated. You have the soaps, the toothpaste, etc. So how do you beat the D2C, which is really competing in the urban space? So FMCG, those players which are actually focused on the rural space would tend to benefit more because there you have lesser competition from D2C per se. And, if the rural economy is turning, then FMCG players focused more on rural areas are likely to benefit.
Yeah, no, okay. FMCG players focused on rural areas where there is lesser competition from some of the D2C players is what you're focused on. Actually, my question was consumer. Anything else consumer apart from FMCG? If there is this consumer pickup, which has been long awaited, but which is not really materialized, anything else? Any other segments you're focused on?
Hotels. Hotels are going to benefit magnificently. Anything to do with travel, and hotels basically are the business of managing sleep. A guy has to sleep at night, and look at the number of passengers traveling every day. 5 to 6 lakh passengers traveling by air. You have 1 crore passengers traveling by train, and you have 1 million passengers traveling by road. Now, assuming half of them actually stay with the relatives, the balance half have to sleep at night. And this would include all the unorganized guys, the OYOs of the world, the Airbnbs of the world. Plus, you have just the number of organized hotel rooms in the country, anywhere between 3.5 lakh rooms. and supply of hotel rooms can't exceed more than 5 to 7% every year. Just you see the demand and supply gap that is existing as the economy grows between 6.5%. We are not only talking about leisure travel, we are talking business travel. And look at the occupancy rates, 70% plus. Tariffs are on the up move. And, you have the ARRs, which are...
Yeah.
No, and you just got to...
No, but Manish, the story, I mean, no one can debate the story and the potential, because I think it's a reversible change. When we talk about where we want to spend the money, I think taking a holiday or a short trip is the first thing that comes to people's mind. The question is on valuations. Where do you see valuations? I mean, are they comfortable, not? Indigo's, I mean, for instance, at all-time highs.
No, so Surabhi, you got to actually figure out the certainty of the earnings coming through. And in the case of hotels, of course, you could debate that last 2 years rate of growth might not come through in the current year. But can you see the next 5 years of growth come through for the hotel space? I mean, it is a given that given the demand and the supply mismatch, I don't really think valuations are going to come off very, very easily. So you'll have to basically have a waiting game as far as you're making money from the current price levels. But there is higher degree of certainty that valuations won't correct massively. So you'll have, let's say, the leader in the pack. Then you have to figure out the discount vis-a-vis the leader. But it all boils down to growth, the margins, and I think margin certainty looks pretty okay in the current scheme of things. So yeah, the valuations are not very cheap. So is the case with, let's say, hospitals. The demand and supply gap is just too big. Are you seeing any comfort in terms of near-term valuations for hospitals? No. But are you seeing growth come through for the next 3-4 years? The answer is a yes. We'll have to wait.
Hotels and hospitals, huh, Manish?
Yeah,
or both, or hospitals like hotels?
Yeah,
joke.
But cutting out your real estate.
No, real estate. And you go to sleep, as you said. Interesting conversation. Thank you very much, and we'll sort of pick up on some of these points as we go along in the future as well. I think we have the next management. IKS Health Services is with us. They've done an acquisition, and now the company is with us to talk about that acquisition. So let's bring in Sachin Gupta, founder and CEO at IKS. Sachin, good to have you with us here. Good morning. Just take us through this acquisition. Is this a different segment than what you do? Because what I read is this: they kind of sort of upstreams the alignment with physician group via what is called the MSO, which is what you've acquired, Management Service Organization. So very simply, what you do and what this company that you've acquired does, and what are the benefits? Go on.
Good morning, Prashant and team. Thank you for having me. So essentially, this is a joint venture where we have acquired a 48% stake in this management services organization that essentially is going to provide all the administrative services necessary to run this about 100-odd doctor-physician group that is in the Pacific Northwest, just outside of Seattle. And it really is a part of our larger strategy to go upstream. And if you don't mind, I'll take a minute to explain why we even came up with that strategy. But if you really think about it, the US healthcare market has consolidated rapidly. The physicians, there's about 950,000 physicians in the country. And it was a highly fragmented market when we started the business. 60% odd of those 950,000 physicians existed in groups of 5 or less. Fast forward 18 years, more than 60% are now in consolidated entities, either owned by private equity or owned by large hospital systems. Unfortunately, the key drivers of those consolidation, which is to lower total cost of care, improve quality of care, improve access to care, and improve the patient experience. When you look at those metrics, the consolidation hasn't been able to truly service those key metrics that would improve healthcare. In parallel, IKS built our platform, where at the deployment of our platform, these physician groups, one, are able to reduce provider burnout, improve physician-patient engagement, and hence quality of care, and fundamentally transform their own economics by deploying our platform, which produces nearly 1,000 bips of incremental margin over what they are able to produce after paying for the platform. So, by the courage of conviction that we got from the transformational impact of our platform and the macro in the industry where consolidation hasn't really worked, this is our first attempt to go upstream and say, not only will we deploy our platform in the physician group, but we will now create a second pool of economics for ourselves where we will participate in the upsides that are going to be created through this joint venture entity. And in this entity, what will happen is we will own about 48% equity, and the overall revenue of the medical group will be split in a way where nearly 63% of the revenue accrues to this MSO, in which we own 48% stake, and the balance 37% will be going directly to the physicians to pay for their compensation. And then as we deploy the platform through the MSO to the medical group, we will then start seeing the benefits of the platform accrue in the MSO. And hence, now the one pool of the economics is the economics created in the MSO entity, and the second pool of economics is the traditional economics that we will create in the IKS P&L through the deployment of the platform via the MSO.
All right. Hi, Mr. Gupta. Thanks a lot for joining in. Just a simple question. IKS has been focusing on improving margins. I think they scaled past the 30% odd mark. With this MSO that you're talking about, how does it change the margin trajectory from here on? And will it contribute to the upside?
So, Nigel, what we've essentially always said is that we are on this journey post our acquisition that we did in October 2023, prior to which our margins used to be north of 37, 38% EBITDA, which came down to blended margins of about 24. We said we were back on this journey to bring the margins towards the early to mid 30s. If you see our Q4 results for the last fiscal year, we'd already hit a north of a 31% EBITDA margin. So we were ahead of that plan. We think there's still a little bit of runway left in that plan, which I've said publicly in the past. And so there's nothing new that I'm saying here, and we're in the quiet period. But I think we're in that journey of sort of settling somewhere between the early to mid 30s in EBITDA margins. And this deal doesn't fundamentally impact that trajectory. This deal, obviously, there'll be another set of economics created in the MSO, in which we own 48% interest, but the traditional margins for IKS will still continue to be in the range, and that the trajectory that we are going still on, which is to get to the sort of early to mid 30s in the next, say, 12 odd months, we're still very confident of achieving that.
Manish, and what about revenue growth post this acquisition?
Revenue growth, I've always said, Prashant, that the market's growing at 12%, and we look at ourselves as a 15, 20-year growth story from here in a very large TAM, and we believe that we'll continue to grow faster than the market on constant currency terms. Whether now in some, this business isn't as predictable where every quarter is going to be linear, but my whole idea is we will definitely grow north of 12% constant currency, even better on actual currency. And, some quarters will be significantly higher, some quarters will be in that range, but we're confident of that sort of long-term earnings growth trajectory of north of 12% and non-linear growth in margins relative to the growth in revenue.
All right. Mr. Gupta, quick question. I'm just looking at your cash flow. Free cash flows, they've been moving up. Your net debt number as well has been gradually coming down. So you're going to be having a bigger cash pool to spend on. What's it going to be on? What kind of initiatives are you going to take? Is it going to be on technology as well? If you could give us some kind of insights.
Yeah, I think the two drivers of investment, Nigel, will continue to be, of course, we are continuously increasing our technology spend, even though we don't, for the most part, capitalize our R&D spend. If you see our R&D spend over the years above the EBITDA line even, it's gone up from the 2-3% moving towards 5%. As we continue to make our big investments in AI, that spend will continue to go up even as our revenue increases towards the 5-6% mark. The other big investment really from a cash perspective will be strategic initiatives like this, right? We've invested $17 million in this deal to acquire the 48% stake. We will have the ability to invest more if we want to in this deal. And our idea is if deal constructs like this truly start to work out, we're going to try 2 or 3 of these, then it fundamentally changes both the positioning of the business and the upstream opportunity that we create for additional growth. And so I think it's strategic alignments with customers like these, and then continued increased spend on the P&L in technology, as well as we'll continue to do some potential tuck-in type early tech acquisitions. Those would be our primary uses of capital.
Okay, all right, Manish, thank you very much. Shorter conversation, but we're on a earnings treadmill, news flow treadmill today. Thank you very much for joining us, and good luck with that acquisition. More later. Let's shift focus back to the defense space, right? Defense stocks all in focus, lots of tailwind. HAL is perhaps the most loved of the defense names, really. They've given a 8 to 10% revenue growth guidance for FY26, is aiming for 14 to 15,000 crores in capex over the next 5 years. My colleague Mangalam caught up with DK Sunil, chairman and MD at HAL, to talk about their growth outlook, and began by asking him where the company stands in terms of order inflows. Listen in.
Basically, from the 97 LCA order, which is going to be big, upwards of 60,000 crores. So that's the big one which we are now working on, and we expect to close it this year. On an average, we do about 20,000 crore of RMSO orders, which are the regular repair maintenance orders. This year, we will be shortly closing a 2,000 crore order for the Dorniers, which is in the final stages. But the year, we hope we will be able to bring in that kind of number, about 1 lakh crores.
Right. You know, very recently, the Defense Acquisition Council also went ahead and announced procurement plans worth nearly 1 lakh crores. Does HAL stand to benefit from that?
Yes, in fact, one of the items was the Sukhoi 30 upgrade, which is a upgrade of the avionics for about 84 aircraft. So this was earlier cleared in the DAC, but there was some clarification which got cleared in this DAC. So now the CCS paper will move. This will be a very big R&D effort for the Sukhoi 30, which will take about 5 years to complete. And 84 aircraft will be upgraded, and that will, production will, the overall and repair and the upgrade will pan out after 5 years. And it's expected to be about 65,000 crores.
All right. And you've also bagged a 156 unit order for LCH. When does execution begin on that one? And what is the annual run rate that we can expect from the Tumkuru and the Bengaluru plants for this one?
The contract was signed in March this year, March of 25. So 3 years is the start of production. So FY28, the aircraft will start rolling out. And we expect to produce at the rate of 30 aircraft a year. So the whole run will be completed in about 6 years. The split will be mostly, it will happen in Tumkuru now. Initially, a few will be built in Bangalore facility, but we will move over to Tumkuru, and the helicopters will be built predominantly in Tumkuru. We already have started producing the LUH there. So the facilities are up, and that will be expanded to cater for the LCH also, which is the Prachand.
All right.
We expect to close it in 6 years from FY28 onwards.
6 years from FY28. You know, you did say that there is maintenance, repair, overhaul of almost 20,000 crore rupees coming every year. Not only that, you're also looking at some sort of MRO for civil aviation. So just wanted to understand your own vision on how much do you expect MRO to be as an annual business for you going forward?
I think we are still taking baby steps in the civil MRO. We have tied up with Airbus, and we are getting our facility and people certified at the Nashik plant. And end of this year, we will have this certification of both DGCA as well as the EASA certification, the European certification. So our expectation is the initial numbers will be small, nothing much to speak about, maybe 100, 200 crores. But going forward, we want to make it as one of the important verticals. So this will build over a period of time, but the initial numbers are going to be small. So the investment that we are making is essentially for the long term.
All right. So all said and done, what is the kind of revenue run rate that you will do in FY26, FY27 and FY28? I ask you this because you are sitting on an order book of roughly 2 lakh crore with an order inflow of roughly 1 lakh crore in this year itself. If you could give us a glide path of the revenue that the company will be posting over the next 3 to 5 years.
Yes, we are looking at the growth, double-digit growth. We had a setback last year because of the supplies of the engine. But definitely our growth will, going forward, be much higher. Definitely 8 to 10% or more. And we expect that as the different aircrafts go into production, the LCH will get into production in FY28. We will now be doing the procurement, and the LCA, of course, 83 is already on. The 97, if the order is concluded this year, it will get into production 3 years down the line. So we see a very healthy growth in the top line. 10% is definitely doable, and much higher than that is what I expect.
You've earmarked capex of what, 14 to 15,000 crore over the next few years. Can you break that up for us? How much of that would be deployed towards aircraft? How much of that would be deployed towards MRO? How much of that would be deployed towards something like a helicopters? If you could break that capex up for us.
A lot of it is in the R&D. We are spending almost 4,000 crores for the IMRH program. We are spending the capex in the Tumkuru plant is going to be of the order of 2,000 crores plus. And we are also investing a lot of money in other projects of R&D. So predominantly over the next few years, the investment in the facilities, investments in software, investment in test facilities, this would be of the order of, for the next 5 years, of about 8,000 crores. And the balance would be mostly in R&D projects going forward, which are all big ticket items like the IMRH or the CATS Warrior, HLFT. These are all big ticket projects where the funding is from HAL.
Drones. You said that there is a test that you're working on. Do you see orders coming in for UCAVs? What's the opportunity size here for you?
Definitely. As has been demonstrated in the Ukraine war or the recent conflict between Israel and Iran and so on, we're seeing that drones will play a big part in these conflicts. However, we are focusing on the bigger UCAVs, which will be, the UCAV that we are working on is 3 ton, and we expect it will be higher in the future years. So this UCAV business is going to be big in the future. Right now we are working on the design and development of the UCAV, and we are at a stage where we are integrating the test engine and going forward. But my expectation is 10 years down the line, this will be a very significant chunk of our portfolio.
And also SSLV, because the street believes that space will also be a big part of your overall scheme of things in the next 5 to 10 years. If you could give us a potential market size here.
The SSLV, as you know, is a very heartening development that we have won it against competition. We expect conservatively to do about 6 launches a year. 2 years, the first 2 years we'll spend assimilating the technology and building a couple of prototypes. Subsequently, we look at conservatively 6 launches a year, which would easily add about 1,000 crores to the top line, and going up to maybe 15 launches a year based on how we are able to market it and get space. So I think in the next 5 years, we should have at least 1,000 crore turnover from this business.
You do believe that, revenues can compound at over 10%. You are looking at over 180 aircraft to be delivered over the next 5 to 6 years, which implies that at some point, all the 3 lakh crore of your order book that you will get over the next 1 year, including the orders that you have in hand, will be executed over the next 5 to 7 years. What kind of margins will you enjoy each of these years? Will you hold on to this 31, 32% band, or do you have the wherewithal to go higher from here on as well?
No, I think we will maintain our current EBITDA. That is what I would like to say at this point. Definitely we'll be able to maintain this. And as you have pointed out, this 3 lakh crore will play out over slightly more than 7 years. It will be about 2033, about 8 years. But we expect to maintain the EBITDA, the current EBITDA that we have.
Have you heard from the government on them looking to further pare their stake, or you looking to raise some money via an offer for sale or something? Is there any opportunity?
No, right now, I think we are at a comfortable level. There is no discussion on that. No discussion about dilution of the government stake.
Okay, well, that's the management of HAL, and we'll sort of play out excerpts of that interview. As I said, perhaps the most loved defense stock out there in the market, really top of the league. Well, I think 20 points lower on the Nifty, so it's turning out to be a pretty quiet start to the week. We'll take a quick commercial break here. Primary market action next in focus. We'll have Varun Kapoor and Vikas Kapoor of Travel Food Services Limited. It's a 2,000 crore IPO offer for sale. So that conversation coming up in just a bit.
Welcome back. As promised, let's talk about the primary markets now. Travel Food Services, 2,000 crore rupee IPO opens the subscription today. This is entirely an OFS. The promoters and the company have raised close to around 599 crore rupees by the anchor investors, and some of the notable names could come up for you on the screen as well. But let's talk about the business in detail as well as the IPO offering. Well, let's understand the business. We have Varun Kapoor, the MD, as well as we have Vikas Kapoor, the Chief Financial Officer, who joins us. Hi, gentlemen. Thanks a lot for joining in, and looking forward to interacting with you all more often. Well, let's talk about the financials a little bit first. I'm looking at it over the last few years. Revenue growth has been in the vicinity of the mid-20s on a CAGR basis. And EBITDA margins, could include the rent as well. So I'll stick to the PAT margins. PAT margins have been in the vicinity of around 22% or thereabouts. Right. Do you believe this sort of a momentum can continue?
So thank you, Nigel, for that. And thank you for having us in your studio today. So yes, our business, we focus on travel, QSR and lounges as a business. In aviation, we've built the business over 16 years, and we are today looking forward to accessing the public markets. In terms of our business, the business has grown quite well over the last few years. It has continued actually over the last decade or so, but last few years, you can see that trend very much being there, where we've grown strong in the business, and we expect that we're in an industry that's growing quite strongly as well, expected to have a CAGR of about 20% over the next decade or so. And, with the, as you could say, the drivers of passenger growth being a key area of growth behind us, the tailwind that actually allows our business to grow consistently forward. In terms of margins as well, we have achieved margins of 21 to 22% levels over the last 2 years.
PAT margins.
PAT margins at our business. We do believe our teams are very focused on driving that. Our teams are very focused on initiatives. Our teams are very focused on driving those robust margins. And those efforts will continue. I mean, just to give a perspective, what drives that as well, our business is investing upfront. ROC is a big part of our business. We've achieved about 50% ROCs consistently over the last few years, including the last year, which we disclosed recently in our RHP as well.
Okay, all right. Just one more question before my colleagues come in as well. We talk about the unit economics as well. One big issue over the last few weeks has been what happened with regard to Dreamfolks. And it appears, they were the aggregator with regard to airport business. Right. Could you tell us, is there any kind of risk? Because their call was, the airport operators are putting pressure and various other claims were made. Is there any that sort of risk on your business, or do you think you'll protect it?
So our business, so we are the operators of the lounges.
Yes.
We work closely with our airport partners to create value for consumers, consumer delight. That's by designing, by building, and actually operating these lounges. Where we work with multiple partners, lounge access partners, whether they're airlines, they could be card networks, bank companies, or lounge access programs or loyalty programs like a Dreamfolks would be. Ultimately, the consumers coming to the lounge would come to any of these partners for us. So we are agnostic, and in some sense, what's happening recently where they're actually tying up directly with us tends to be an advantage. Tends to be that customers are directly coming. We can communicate, we can actually create different levels of experience directly with partners as well. So, that's what's, in a sense, occurring today in the industry. So, in a sense, it probably occurs as a positive for the development of the industry.
I just want to also tell our viewers that yours is a very touch and feel business, so that to make it easier for people to understand, all the idli.com and the cafecinos that we see at a lot of the big airports, run by, of course, Travel Food Services, TFS. Vikas, just come in on this point on lounges, because that's a very big part of your business. Your current revenue mix is almost evenly split between your own brands and the food courts that you're running with your partners and this lounge business. Just if you could supplement this, if there is disruption and say the lounge business is taken away from Dreamfolk, how does that impact your lounge revenue, if at all?
Thanks for the question. What exactly happens is the lounge business by default is, like Varun mentioned, is supplemented by multiple layers of like airlines, loyalty access programs and multiple. So what tends to happen is, if suppose there is a challenge on one lounge access program per se, typically you would either get the customers directly, or you would get a new access program provider who would be providing that services to you.
Dreamfolks accounts for how much of your overall lounge revenue, which in the last year was around 830 odd crores. How much of that would be from this one lounge service provider?
So from that perspective, yes, there would be a sizable portion from that perspective, but the way it is happening is that most of the banks are directly tying up with us to provide the lounge access. So for us, there is no impact.
Those negotiations and that changeover period is already on.
Right. Yes, and we work as well, a big part of the business as well as airlines. Airlines has been the part, especially international when you fly, no doubt, that tends to be a big component.
Varun, Vikas, great speaking with you, and congratulations on the issue. So for a lot of viewers, a little confusion. Many are asking us online whether you are in the same line of business as Dreamfolks, which you're saying you are not. They are an enabler, an aggregator, whereas you're the operator.
That's right. It's a very different business. They would be one of many lounge access programs we work with. We are the actual players who build the lounges. We actually operate these lounges. We take the real estate, and we have these long-term contracts. So our contracts are about 8 to 9 years. We work closely with airport partners. As they look at upgrading the whole experience at airports, we work very closely with them in that. So we're actually building these lounges.
Right. Ensuring that the sambar is piping hot every time you
That's
what it is. And I'm very particular about my food.
But don't get me started on the sambar, because I'll go on about the cost. And of course, online, you guys must see, right? People, there'll be the cup of chai which will come up and priced at whatever 800, 700 rupees, and
it's about different experiences.
It's a raging debate out there, right? But on the lounge business, the number of flyers has exploded over the last few years, right? So it's been a different league, in that sense. But access to lounges is also pretty democratized now. So many, it's not that hard in terms of the number of cards which are accepted, etc. How do you earn revenue in the lounge business? One is of course what you sell in the lounge. Right. Is there anything else at all?
And if I can supplement that question, because in between over the last couple of quarters, there was also a phase where banks were pulling back from this business because it was just not profitable, because every card could get you a lounge access. So your thoughts, going back to Prashant's question.
Right. No, exactly. And you see, ultimately it's about the consumer experience. You had restaurants and airports. Today I probably say I think the way airport operators in India have approached airports, I think they made it in some cases better than malls on the high street in terms of the brand mix that you see. And we're focused on delivering that. We're focused on creating those experiences. So both, whether it's travel QSR with some of the brands you see at the airports, and lovely to know idli.com is one of your favorites. So that's a great testament. But, in addition to that, lounges as well. Lounges are a place, you're traveling, you have high dwell times. You want a space of comfort. You want a space you can spend some time. It creates an environment, or oasis of a cutaway from the rush of moving.
But you're contingent on banks being solid partners and bringing in the footfalls, right?
Completely. So whether it's a bank, whether it's an airline, whether it's a card network, and you're seeing more and more consumers appreciate that. And exactly to your point, and not only that, it's happening globally. I mean, India, no doubt. You're seeing that every time. Lounges, many times, are asked as one of the top reasons of, we're partnering with the card companies, banks, because the level of service every year is going up and up. Every lounge coming up.
If a consumer spends 100 rupees at a lounge that's operated by you, how does it split across you, the bank, and others?
So, Prashant, the way it works is we tie up with these access programs, and they pay us per user coming in. So we get paid per use. And I think what's happening as well today is, one is that is a part of the revenue. You have walk-ins as well. But in addition to that, you have people who come to a lounge, and today you see a spa. So, so additional services as well.
The value-added services.
Value-added services. So spa. Today you see, bar in a lounge.
So if you could give, numerically, if you can just sort of disaggregate that number, Varun.
So the larger portion would be the walk-in. I mean, the customers who come through the
card programs.
The card programs, the banks, the airlines. For example, international, you'd imagine airlines, business class. You're a first-class traveler. You come to the lounge. You have a separate zone for the first class, separate zone, for business class as well. So that tends to be a large portion of it.
And which business fetches you better margin? The lounge business, where all these tie-ups are vital for that business to thrive, or the regular food court business? Right. Which gives you better margin?
That's a great question. In reality, for us, it's materially both the margins. Ultimately, we're delivering from both of these consumer delight, and margins are quite similar across both businesses, not materially different. And a lot of synergies between both.
Right.
You have central kitchens, central stores, procurement is together. So a lot of these type of comments.
All right, just to wind things up, so you're confident with regard to the revenue growth momentum, profitability can be maintained, return ratios can be maintained, and you don't see any kind of risk like what's happened with regard to Dreamfolks, because your business itself is totally different. Is that fair?
That's fair, Nigel.
All right, we'll let you all go at this time, and all the best for your IPO opening. On listing, we re-invite you all on the channel. Yeah, sure. At that point of time, we'll squeeze you a little bit more for some numbers.
We love that. Maybe a few recipes we could discuss.
And I'm a customer both, lounges as well as the other business. So I can quiz you on everything on the operational front.
And one suggestion, maybe you could introduce a frequent flyer program for idlis and sambar.
Like a loyalty card. Absolutely.
Something like that is going on in the mind. So
nice.
Thanks, gentlemen. Thanks for coming down.
Thank you. Thank you so much. Well, that is TFS, a new issue that is coming to the street very, very soon. But let's go back to some important updates that we got from Borosil Renewables. Let's pull up the stock. Last I checked, it was still up about 3% or so. Now, the news is that one of Borosil Renewables subsidiaries, in particular, this is the German subsidiary, it has filed for bankruptcy, citing demand paucity and market conditions. The stock, however, has been holding up 4%. Perhaps the market feels a sense of relief that there's a finality to this, and now one can move on with the repair work. Let's discuss this with the company's management. Pradeep Kheruka, Chairman of Borosil Renewables, is joining in. Mr. Kheruka, thank you so much for taking this call, sir. So that's exactly what we need to understand. We believe that your exposure to the subsidiary was around 350 crores. But what is the debt remaining? What happens in the bankruptcy? And to what extent can your exposure be impacted? If you could just walk us through.
Sure. Thank you for having me. The debt in the company now is from Borosil Renewables itself. We have no external debt with banks or any other lenders. So to that extent, we are not facing any hostile action by any third party. The fact is that there has been a demand constraint, a significant demand constraint, because of a stoppage of manufacture of solar modules in Germany. All of these are now being imported from China. And the government has just taken office a short time ago, sometime around the 10th of May only. And I think they have so many issues to grapple with at this time that it's just going to take some time before they wrap their heads around the solar industry sector. But in the meantime, we have been losing money to the extent of nearly 900,000.
Oh, I think we've just lost that line with Mr. Kheruka. We'll try and get him back. But, that's essentially the thing that we need to understand. At least the bleeding stops, because this was a loss-making entity as well. So the market just seems to be relieved that for starters, at least that bleeding stops. And then it's a question of recovery of investment, whether that happens or not, in what form. That's something we'll try and understand.
So the only thing that I was surprised is that, as Mr. Keruka, before he got cut off, said that there's a new government in place. And they've got lots of things to deal with.
Yeah.
But they're sort of getting out of this business in Germany at a time when you've got a new entity which is expanding, the fisc, etc., in a very substantial way in terms of increasing spending, state spending on a lot of things. So why now? I mean, if anything, you'd probably wait for a bit longer, or were there other circumstances as well which kind of sort of forced them and forced their hand? I think Mr. Keruka is back. Mr. Keruka, you got cut off there, sir. Please continue.
Sorry about that, yes. Swiss connectivity is not as good as Indian connectivity.
Indian connectivity. Go on, sir. Go on.
Okay, so I was just saying that the government probably needs some time to wrap its head around how they want to restructure the solar manufacturing in Germany. But in the meantime, since we were losing money at this very high rate of nearly 9 crores every month, we thought it was not fair on Indian investors for us to continue to bleed in this manner. And we decided to just... we decided to stop funding them. So the application has actually been made by the German managing director under German law when they see that there's no visibility of funds in the next 2 weeks, and then they must compulsorily file for insolvency, which is what they've done. And so we at this time there's an interim administrator who's been appointed, and he'll make a report. And then he's going to go back with his recommendations, which might take about 3 months. If in the meantime there is some movement and there is clarity about how the German government is going to support German industry.
Mr. Keruka, if I can just come in, is there like a one-time write-off here? One. Second, can you kickstart this if there is clarity on the positive side?
You see,
Restart rather. Sorry. Go on.
Right. So let's look at it from 2 aspects. One is the technical aspect. Technically, all you have to do is start firing the furnace. You switch on the gas and you switch it on and you're back to production. Technically, that is the story. We have a full complement of workers there who are experts. They know their job and they are very dedicated, strong people. I have a lot of respect for the workforce there. They would be available, I believe, at short notice to resume work should the circumstances allow them to do so. And as I've seen before, the investor is looking at visibility. If the investor sees visibility, there's no shortage of funding. So I suppose that this is going to follow the same pattern. So we do have a 3-month period in which we're going to see what kind of a response the administrator is able to generate. Right now, it's outside our hands, number one. Number two, the clear thing is we've stopped funding this. In future, any demand for any money will go to the German government and not to us. So we have sort of, we have ceased to be responsible for the expenses.
All right. Sir, that point, will that be a one-time that will be seen in one of these quarters? If yes, what could the quantum be?
See, our exposure is 35 million euros altogether. We have funded about 20, out of this was 27 million was funded by us. So the exposure is not something which I can speak about now because we have sizable assets. There's a very large plot of land. There's a very strong construction. There could be other uses to which this property could be put. And there might be customers for the property itself. There are, of course, plant and machinery for which we could be one of the customers, because a lot of it is brand new. So it's not necessary that the entire amount that we've invested will be written off, but this is just something on which I simply cannot make any comment at this time.
Okay. All right. So I think the street views it as a positive that now you can focus on the core India business where you have some protection as well. And the margin difference has been substantial because the entity that we're talking about in Europe is loss-making, while India business is expected to improve from year on. So purely for the India business itself, could you tell us what is the realization difference if I look at it, on an average today in comparison to, say, Q4, very, very roughly? And what kind of a CAGR can you look at on the India revenue from year on and margin trajectory as well? I recall you doing 30%. That came down to mid-teens, but that's expected to improve as well. Please go ahead.
Yes, please. Margins are definitely on the way up. Demand is robust in the country. We are focusing on maximizing production, and we are focusing on
Again, we've lost
demand
that line.
and getting ready for that. So the picture here is very positive. Yeah.
Mr. Kheruka, just a...
Are we back?
Yeah,
Yes,
we
sir.
can hear you. Please go on, sir.
You were giving us a number. What kind of revenue CAGR can we look at and margin trajectory from here on for the India business?
The margin trajectory is only going to improve. It should not deteriorate from what I can see. The demand is very robust in our country, and we continue to meet the demands of our customers. So we're looking at a 60% expansion, and this will allow us to devote our full time to this. In the past, we have been devoting time to things that were not productive. And I must take out time to comment about the government. Our own government is very proactive. And when I see the difference,
Mr. Kheruka?
We are headed, yes.
Yeah, sorry. Paucity of time, so just trying to squeeze in one last question. So you are, since the company's filed for bankruptcy, your German subsidiary, you ceased to be promoter immediately, and this was contributing 22% to your revenue. Will that be made up by the India business this year itself? I mean, in the interim, suddenly the 22% is gone, right?
Yeah, the revenue has gone, but the profits have gone up.
Yeah.
I mean, to the extent maybe nearly 27 crores per quarter is going to rise. So that revenue was not giving us anything. It was taking it up.
Sure.
They won't lose money on sales now.
And 27 crores of additional profit every quarter. That's an important, of course, something that your shareholders will like.
All right, Mr. Kheruka, we'll leave it there, sir. Good speaking with you on a patchy line, but I think on a firmer line next time you're here. Look forward to our next conversation. Appreciate you joining us here for that chat. We'll take a quick commercial break here. Commodities in focus next, and of course, that chat on the economy with Lata coming up as well.
Welcome back. Let's quickly do a roundup of the commodity market headlines this morning. Manisha is here with us. Manisha, fill us in.
Thank you for that, Surbi. I'm looking at the crude oil prices because the previous week wasn't such a great one, and we've started this week as well on a weaker note. And this has led to week-on-week, month-on-month crude oil prices trading into the negative. And in this year, until now, we are 8% in the red as well. Well, the major cue really comes in from the OPEC Plus meeting that happened on Saturday and the kind of statements we heard from therein. So OPEC Plus has accelerated production hikes, citing stable economy, low oil inventories, and sustaining demand in most parts of Asia. What OPEC has done is that it has hiked production by 548,000 barrels per day for the month of August. And the expectation is that this is the number you could be looking at going forward as well. What we saw for the month of May, June and July was 411,000 barrels per day of an increase in production. So you have a big number coming in for the month of August. And this clearly has been rising as we've seen in the previous months as well. So that is what really seems to be bothering the screen. Apart from that, it is OPEC Plus unwinding. Remember, 2.2 million barrels per day. This is over and above what the OPEC and OPEC members have been withholding, looking at the kind of supply that they have been seeing in the global markets there. Well, apart from OPEC, it also has to do with the US tariffs, where the street expects that it would take effect now from 1st of August. That doesn't do very well for many of these industrial commodities with the kind of impact expectations from there. The other is the US finalizing rate amid ongoing negotiations, and the street is also looking at the weak China services activity, surprise build-up in the US inventories. All of those things have continued to weigh onto the markets there. The US crude inventory in this week, if you see a hike, would be an 8th straight week of hike coming in, and that doesn't augur well for the price increase there. What the street will watch out for going forward now, of course, is the FOMC Fed minutes that's going to be released on 9th of July. And apart from that, all the tariff conversations that you will be seeing will impact many of these commodities.
All right, Manisha, thanks very much for that. That's commodities in focus. We'll take a quick commercial break here. It's the economy in focus. My colleague Latha will come in for the conversation. And we'll have three top gentlemen joining us, Ajit Chenoy, Rajkiran Rai, Indranil Pan, on that discussion. Coming up in just a bit.
Welcome to Economy Unpacked. The Reserve Bank has infused 9.5 trillion rupees of liquidity since January and has cut repo rates by 100 basis points. The call rate actually has fallen more. It's fallen from 6.75% in January to 5.25% in June. Now, the question we're asking is this enough to increase credit growth, which had fallen to a low of 9% in year-on-year terms in June? A JP Morgan study argues that higher liquidity can pull down call rates by a quarter basis point below the repo rate. But higher liquidity by itself cannot increase credit growth, which depends on other factors, maybe they mean factors like animal spirits of businesses. Separately, historical evidence shows that the Reserve Bank lowered rates from about 10% in FY98 to 6% in FY 2004. But for the 4 years from FY 2000 to FY 2004, credit growth remained muted. At that time, 15% was considered muted. However, it raised interest rates from 6% in FY 2004 to 8% in FY 2008, and credit growth rose in those years by around 25 to 27%. So the question we are asking today is, should we expect strong credit growth given the high liquidity and credit rates announced by, rate cuts announced by the Reserve Bank? Joining me are Sajid Chinoy of JP Morgan, Indranil Pan, the economist from Yes Bank, and Mr. Rajkiran Rai, Managing Director of NABFID, and of course, former Managing Director of Union Bank. Gentlemen, thank you very much indeed for your time. Sajid has just published an extremely erudite paper on this. Sajid, in simple terms, why are you arguing that liquidity is not enough to boost credit growth?
Thank you, Lata. The motivation for our piece was, over the years, there's been a rich debate about what role liquidity plays in addition to rate cuts or rate hikes in the monetary transmission process. Should the surplus or deficit be 1% of NDTL? If you inject more liquidity during easing cycles, do you get more transmission? Will that help credit growth? And there are two main channels of transmission that the debate is centered around. Does more liquidity result in higher interest rate transmission? So it pushes call rates down, as you said. But beyond that, does it push lending rates down for banks if you inject more liquidity? And the second channel, in fact, is more important, something that Ben Bernanke argued over the last 20 years, what's called the credit channel of transmission. That if there is a lot of availability of liquidity, then banks tend to lower lending standards, lower risk standards, and credit growth picks up irrespective of interest rates. So what our study did was, over the last 10 years, look at both these channels quite rigorously. What did we find? Number one, that liquidity clearly has an impact on call rates, about 25 basis points, as you said. But beyond that, once you adjust for the call rate or hold it constant, there is no incremental impact of higher liquidity on lending rates. So all the transmission works through call rates. Number two, and this was the interesting finding because in a way it's slightly different from what the RBI had found back in 2012, that really liquidity by itself does not cause higher credit growth. We've looked at this in many different ways over the last 10 years, and we find no evidence that just injecting liquidity by itself does not boost credit growth. So there is no evidence in India of a credit channel of transmission. The third and final finding was, when we talk about what's driving what, does deposit growth drive credit? Does credit drive deposit? And we find it's the latter. It's really credit that's the initial mover. It's credit growth that drives deposit growth, which in India's context is good news because it means the credit deposit ratio over periods of time tends to mean revert. Now, I'll make one final point. This is not to say that credit growth will not pick up in this cycle. As you pointed out, call rates are down 150 basis points. We find in our work that there's an 80% transmission on average to lending rates. So over the cycle, expect lending rates to go down by 100 basis points. That should, of course, help credit growth. But as you also pointed out, what we find is this positive correlation between lending rates and credit growth, which is very intriguing and interesting over the last 20 years. That is really, credit growth seems to be associated with higher lending rates, which tells you that apart from movement down the demand curve, what matters in India is whether the credit demand curve itself moves out, which is a function of growth prospects, private investment prospects, animal spirits, and the like. So these were kind of the findings that we concluded.
Okay. But let me tell you a story that I heard from bankers around the time when you presented the inflation targeting report along with Urjit Patel. You were part of that committee. The Reserve Bank at that time, because of the Urjit Patel report and the Mohanty committee report, said that, to keep repo rate at keep the call rate at the repo rate, we have to keep liquidity slightly less. Only then the policy rate aligns with the repo rate. But because of that, people were not cutting rates. When the Raghuram Rajan RBI asked bankers, why are you not cutting? We have cut rates. They said, see, as long as we are borrowing from RBI, our psyche is there is not enough money. So we are not cutting deposit rates. So you keep liquidity in plenty, then only I will cut deposit rates because I feel, okay, I'm not borrowing from RBI or from call market. This was the psyche that bankers explained to RBI. Those two bankers, Hitendra Dave and Anant Narayan at that time, now in SEBI, said that even on our channel. So Rajkiran Rai, is that the argument that bankers want liquidity and otherwise they won't cut rates? So liquidity has a role in rate transmission.
Definitely, yes. Actually, see, liquidity is very important because you would have seen the deposit growth in the system moderated a lot actually because there was tight liquidity in the system. Another factor is actually when the credit growth slows down, the deposit growth also slows down. So I think these are all very interlinked. Sufficient liquidity in the system has already brought down the short-term interest rates, is already helping in cutting the deposit rates. You would have seen the banks have cut deposit rates substantially now. So now actually it will play out. It takes time. But then the argument is right that bankers will always look for liquidity, tight liquidity conditions. Actually, banks compete with each other for bulk deposit, for deposit growth. And when the deposit rate goes up, the interest rates are always kept high.
Okay. No, I think we are not just, tight liquidity obviously will not push up credit growth. But what Sajid is arguing, I guess, is that just surplus liquidity is not enough. Sajid, I'll come back to you for your rebound reaction. But Indranil, where do you stand? Do you think surplus liquidity gives bankers the psyche to pass rate cuts, and that in turn should logically increase the demand for credit? You're on mute.
Hello. Sorry, I think the context here is more in terms of what is the extent of liquidity that you are talking of. Now, for example, in the current scenario, we are almost a 4 trillion surplus in terms of liquidity, and the RBI has absorbed only about a 1 trillion through the VRRR. Now, again, I think that going back, the whole argument boils down to whether you operate at the lower end of the corridor. And in that case, it is only the near-term securities in terms of the T-bills or etc., which actually get the transmission at the highest level. The credit growth possibly doesn't happen, and the credit growth will depend a lot in terms of the type of demand for credit that is there. Now, in the current circumstance, I'm not sure whether a 2 trillion or a 4 trillion can push up credit growth very significantly, simply because of the cycle where we are in. First of all, I think the FSR report also did point out that there is an increase in per capita debt for the subprime category borrowers. And therefore, to that extent, the credit demand, which is basically the housing sector, obviously is the prime category and the super prime category, but more in the middle segment where you still have a stress in terms of the post-COVID debt weight loss. Okay. That is the zone where credit has been increasing the maximum. And that's possibly where the banking sector had also been hurt in terms of the incremental NPAs over the last couple of years. Okay. So in terms of credit standards or the risk undertaking that the banks are willing to take even for that segment may actually be relatively lower. The RBI also had increased risk weightages over there. Okay. So I think there's a lot of things. It's not only liquid that impacts the credit growth cycle. It also depends significantly in terms of both banks' risk-taking capability as well as the demand.
Got it. Mr. Rai, you wanted to react?
Yeah, actually, let us expand this discussion because we are trying to connect liquidity, interest rate, and credit growth. Now, you cannot limit the credit growth only to the scheduled commercial banks because growth is happening somewhere else. Because infra space where I operate, the scheduled commercial bank number, if you see, they are minus 1%. But if you look at the NBFC and AFI space, they have grown 15%. Look at the InvIT assets under management. Okay. Now, today, they are 7 lakh crores. They have grown 10 times in the last 5 years. Okay. They are expected to be 20 lakh crores. Okay. The flipping of the assets from the scheduled commercial bank.
That expands beyond. I'll come to that. We are at the moment looking at whether bank credit can grow. Right? Sajid, you wanted to react. I mean, liquidity does give bankers a psyche of being able to cut deposit rates. Although you are not lending the reserves, but it gives you the comfort.
There's no doubt about that. And I think the point here is that we've recognized over the years that The first leg of monetary transmission, as the Inflation Targeting Committee report had laid out, was to ensure that the operating target of monetary policy, which is overnight money market rates, the call money rate, the TREPS rate, align more closely with the